Hi guys, thanks for tuning into another episode of Nuggets News, or our monthly housing and economy update with our friend Martin North. Welcome back, Martin.
Hello there. Long time no see, but great to have you back on.
Yeah, thank you. There's a lot happening, and obviously it's been a crazy year and difficult year behind the scenes for myself and whatever. I've been pretty open with everyone about what happened, but yeah, it's great to be back and great to have your support again. So plenty happening in the world, and looking forward to getting back into this monthly for everyone.
Yeah, and as I, said about a year ago, you and I on these shows just go through some of the important economic stuff that's going on at the moment, and a lot's changed in the last year, but very important time to have a conversation now.
Yeah, I guess just in general, we haven't done this for a year. The inflation genie kind of came out of the bottle, which is something I think we've both been talking about, that there are repercussions when you print trillions of dollars. And for the first time, we probably saw more direct injections bypassing the banking reserves where all of that money is normally placed, and it leads to all the stock market and whatever the banks want to invest in going up. But we've seen supply chain restraints and another number of other ingredients that have sort of led to this record high inflation, or multi-decade high inflation. So any general thoughts on all that before we jump into the slides?
Yeah, well, I think it's really important for people to understand that Ukraine did not create inflation. Right? Inflation was already raging before the war in Ukraine came over the top. And if you look at where commodity prices were going, before the war started, they were already going up. And so you've got to actually anchor it back to central bank policy, whereas they created this massive amount of liquidity. And as we said, the last year, well, this has got to go somewhere, right? And of course, it went into asset prices originally, but it drifted beyond that. And so the money supply, when particularly through COVID, when they pumped ever more money into it. So it's been created not by the war. Now, the war is a very nice excuse. And it's funny how a lot of people are now saying, it was the war that what did it, right? But no. The war has re-emphasized and amplified something that was already happening. And I think it's really important people to understand that.
Yeah, I think most of our viewers are pretty acutely aware that the mainstream media likes to blame Putin or any topic really. It's just that divisive, try and make everything two-sided, play on people's emotions, and it's rarely the truth.
Absolutely.
Awesome. Well, we'll get into these slides that you've got for us, Martin. So first up here, you've got some Westpac data.
Yeah, so this is the Westpac leading index. And what it tries to do is to pull together a whole bunch of different indicators and say, well, how does it look overall? So it includes international data, local data. And the interesting observation is that we saw a considerable fall back. So COVID, it went very low, it came back, and now it's dropping down again. And this is a very important underscoring that there are cracks appearing in the economic momentum here in Australia, in the US, and other places too. So whilst on one hand we've got all this tension of central banks and putting interest rates up, this is against a backcloth of economic uncertainties rising. And so, it's trying to work out those two forces. And of course, a lot of the central banks at the moment are absolutely focusing in on inflation and trying to tame inflation. But this is against the backcloth of weaker economic momentum pretty much everywhere. So the question is, at what point will central banks then have to turn wherever inflation is to other issues?
Yeah. And more here from ANZ as well, consumer confidence taking a hit.
Yeah, and this is the other point. So, I want to show you a few examples of, where things are happening. So in Australia, the consumer confidence metrics are back down again. So they sort of, lifted quite nicely post-COVID, but they've come back. And if you look at the detail of what the ANZ Audit and Morgan work does, they talk about things like people less confident about buying big things, worried about where inflation's going, and concerned about things like cash flow. So it's no surprise that in Australia, consumers are getting very twitchy. And, partly that, I guess, is the story in the media, but also what they're feeling in their hip pocket when they go out of the shops, when they go to the Bowser to get petrol, wherever you look, it's going the wrong way. So that's another indicator. And very important to understand, as well as the hard economic data, consumer confidence is critical because a large proportion of economic activity in Australia is directly anchored to what consumers do. And so if consumers are getting less confident, they're going to spend less, they're going to hunker down, and that then translates into negative momentum to the economy. I go back to my earlier point. Leading indicators are down, confidence is down. That's a worry.
And you've got the US confidence here as well, which is...
Yeah, it's the same story in the US, and I just thought it was interesting. This isn't just an Australian thing. Pretty much in all the Western countries I look at, confidence has dropped dramatically, and it's all anchored back to where inflation's going, but it's broader than that. So, you got to understand that there are these negative indicators, the cross currents between inflation and everything else. Therefore, it's going to be a tricky path ahead.
Unemployment rate, we've both discussed how these numbers are kind of fudged these days, and it's underemployment and people that aren't counted anymore that are kind of the real issue, but it's official numbers are these lows.
Yeah, so the official number is below 4%. Of course, there's 500,000 temporary workers that left the country, which is one of the reasons why it's so low. And though there are more people who've checked out, they're not looking for work at the moment. In fact, when I made a show a couple of weeks ago on the unemployment numbers, I had a couple of people say to me, yeah, we've stopped looking because we just can't find work that actually matches what we need. So it's really important to understand that these numbers don't tell the full story. And it's funny how the things like the participation rate and the underemployment rate hardly ever gets a look in. So all of the press discussion when these numbers came out were on the top line rate, which is what the politicians wanted to talk about, not the true situation. And then we know that the definition of unemployed is, a particular definition. So there are a lot of people who are actually out of the official numbers. So the real story is a lot worse. And by the way, this is precisely the same as in other countries as well. We are massaging the numbers to represent a picture that is not as really positive as these numbers would suggest.
Next up here, you've got some of the commodity prices you've been talking about already.
Yeah, and just to underscore, the crude oil was up again. It was up to 114, I think, overnight. These charts came from yesterday. And, this is partly to do with Ukraine. But again, I make the point that commodity prices were rising already. And if you go back to 2021, they were at 70. Before the before the conflict in Ukraine, they were up around 100 and going higher. So, another indicator that this inflation genie is not tamed yet. And of course, the oil numbers is very important because it translates through to everything else. So it's the second order impact. So everybody who's driving around, everybody who's actually using fuel as part of their business, it's going to put upward pressure. And recently, ABS put some information out to suggest that nearly half of businesses were expecting to lift their prices to consumers because the costs were actually going up, and the main cost they mentioned was, guess what? Fuel.
Natural gas even more so?
Yeah, and natural gas is another one. Of course, this is actually from the US CME. But the point again is very high costs, another input cost, and a lot of people worry about consumers, but input costs to manufacturing, who use gas, for example, very significant upward pressure. And this is a global phenomenon. So, whatever we might want to think about locally, and by the way, some of our gas prices are more expensive here compared with some of the export of gas that we're making internationally. But the upward pressure, again, suggests that this is not something which is going to actually settle down anytime soon.
Yeah, and also heading into our winter, but heading into, Europe and US summer, if anything, we normally see it the other way around. So unusual to have these big spikes or just something else to consider that it's, I guess, a bit unseasonal for it to happen going into their summer.
Well, and of course, what's happening there with energy costs, for example, are creating mayhem. So in the UK overnight, the government there announced they're going to actually hand out more money to all consumers to try and help with their power costs. So I think it's, several £100 additional support. And then what they're going to do is to put a windfall tax on oil companies, who, of course, are actually making a mozza at the moment, which is really interesting for a conservative Tory government in the UK to basically be robbing the rich to pay the poor. It's a fascinating case study. And of course, it's all because of the very, very big concerns in the UK. About 25% or so of households in the UK are under the guns already in terms of actually cash flow and trying to manage their income and expenditure before the northern winter comes in. And with those high prices, it's a killer.
Wheat and I guess the cost of food in general is another talking point in the media lately.
Yeah, and again, this is partly it was already happening before Ukraine, but Ukraine has definitely created a huge momentum with regard to the price of wheat. Obviously, Ukraine was a big exporter; they've been unable to export, and in fact, at Davos, they were talking about the impact not on just Western countries, but first world countries in particular, third world countries in particular, I should say, where effectively they are reliant on a lot of this grain coming out from Eastern Europe and particularly from Ukraine. Food prices are going through the roof. People are going to starve, and I'm afraid that this shows you again just how precarious living is in many countries. And I get a bit frustrated when everybody's talking about the problems here, and I understand why, but you've got to look at this internationally. There are millions and millions of people who are going to go hungry because of what's happening.
Yeah, and we've seen that in Sri Lanka, running out of oil and food, and sometimes we forget when the media is so focused on the West that there's a lot of countries out there that are doing far worse, as you say.
Exactly. And the last one, just it's worth looking at the price of iron, and this is iron ore fines. It peaked at 220, right, US dollars. Now it's sitting at about 133, and this is important from two reasons. One is Australia has been very fortunate because we've had very high iron ore prices, which means that we've actually had very significant income into the country from those exporters of iron ore from Australia. And the question now is, will that continue? And there are two parts to that. Firstly, what will be the price? And the price is set by demand. And why is demand down? It's partly because China, of course, is still in sort of semi-lockdown with the latest round of COVID. But China has also got economic issues of its own. And whilst it's been trying to stimulate its own economy and cut interest rates a little bit, the forward demand for iron ore looks to be perhaps coming off. Now, if that drops significantly, that's a big deal for the economic momentum in Australia, because we've been really very fortunate over the last couple of years with the high price. It may well come back, and if it does come back, that could be a big deal too.
Yeah, just quickly, I think Australia even had the most benefit from those high commodity prices in terms of our GDP and our debt, even tipping into surplus there for a little bit. But it's probably Australia's that tale of three different sectors. It's that housing and the banking, which all changes dramatically with rising interest rates. And then you've got that retail and discretionary spending, going out for coffees and breakfast and all that. Australia's has some of those highest percentages reliance on that as well. So it's those probably three big things. Or was there anything else you'd add, the biggest drivers of what's going to happen in Australia?
So yeah, houses and holes, right? I mean, that's basically what Australia is. So basically it's all about the housing, because of course that's connected to the banking and the resource sector. We've got one of the narrowest economies in the world, and we've slid further down the list compared with last year. So we don't have much in terms of breadth. And so we're very, very exposed and very reliant on what happens to the commodity sector and to the housing sector and therefore banking locally. And of course, at the moment, banking is looking a little more wobbly now because interest rates are likely to rise. We'll come on to that in a second, and that could actually lead to some interesting pressures on banks. And now the commodities sector is looking a little bit wobbly too because of China and because of the iron ore price and because of all those other things. So, the things that kept the Australian economy strong are looking a little bit wobbly now. And the question is, will the new government, do things to try and turn that around, or will they actually see a slide on their watch? And I would actually argue that maybe this was the election not to win, because I think the next 2 or 3 years are going to be pretty bumpy.
Yeah, Australia's low economic complexity, it takes time to diversify, as you say, and it takes many years, and if whatever government inherited and things go bad, they get the blame or whatnot. But we definitely need to diversify our economy long term.
Absolutely. Now, in terms of interest rates, it's very interesting looking at the ASX 30-day interbank cash rate futures implied yield curve, which is a long way of saying what do the markets think rates are going to do. And it's interesting how that's morphed and changed over the last few months. But you can see that in the next few months, everyone's expecting rates to rise significantly from, 0.285 in February, in May, up to, by the end of the year, more than 2.5%. So they've got a couple of percent locked in. Above that, it looks as though it could then settle. And that's an interesting trajectory change, because if you go back a few months, there was a more smooth rise in interest rates, but going on for longer. And this is a really important observation. We're starting to see yield curves now suggesting that the rates will rise, but then they will go steady and may even, in some cases, fall later. So markets are now trying to actually pick the trajectory, the top, and when they fall. And I think that'll be something to watch, because I think we're going to see more moves in terms of that. But the RBA is definitely set to raise interest rates more. And, New Zealand this week lifted the cash rate from 1.5% to 2%, and they said more to come. The Federal Reserve, when they next move, will probably move 50 basis points. So the interesting question for the RBA, when they next meet, Tuesday, first Tuesday in the month, of course, will they actually lift, and how much will they lift? And some people are saying 25 basis points, others are saying 40 basis points. So expect rates to rise.
Well, to get to these numbers that I guess bond markets and other smart money is predicting, I'm not sure exactly how many meetings the RBA have left. I don't think they have one every month, but they're going to have to do some 50 basis points, not just 25 isn't enough to get to these levels by the end of the year, is it?
Yeah, exactly. And look, the RBA is saying it might be 2% by the end of the year. Well, the market's sort of roughly in line with that now. I think the question will be, how long will they go on for? And that's partly a function of trying to get inflation under control. But the really interesting question is, with inflation at more than 5%, or if looking at non-discretionary spending more than 6%, to what extent do lifting rates control supply chain disruption type issues, right? So what they're trying to do is to get the demand and supply more into, quote, equilibrium, and everyone's talking about an equilibrium between the two. But what it basically means is they want actually to control demand, make it harder and more expensive for people to do things. But it's also an interesting observation that some of the things they may have to do, and I'm taking the UK example with the support for households and power, could well in turn be inflationary. So if they throw more money into the economy, will it actually stoke inflation? So will they actually be battling harder? And there was a very interesting cartoon I saw with Jerome Powell sitting in a vehicle that was sort of turned sideways, and on one side was inflation, on the other side was recession, and he was sort of stuck between the two, trying to work out how to move. And that's a bit how I see things at the moment.
Yeah, I agree. One of my, base cases is that there's going to be more and more universal basic income, whether or not they call it that and they compartmentalise it, like we said in the UK, handouts for energy prices, bigger first home owners grants, whatever the way you want to dress up the cost of living, and the government ends up footing the bill and handing out more and more.
Yeah, absolutely. Yeah, we're going to see a real contention now. And remember that all that money that gets handed out has to be paid for. And of course, we've already got $1 trillion of debt in Australia. In round terms, that's where it's going to end up to. So it's not like we've got, no runway left, but we've got a limited runway. And the other point is, if rates do start to rise, that means that government debt's going to be more expensive, a lot more expensive. So that means they're going to have less capacity to throw money at things, because it's going to cost them more. So there's a big, big challenge ahead, I think.
Particularly in Australia, but Australian banks, I guess just in general, we're relying on overseas funding a lot if rates rise. And I think you've got a couple more slides here that we'll get to that are going to highlight what's going to happen with the Australian bond market and what the RBA have done.
Yeah, absolutely. So the first thing, the 3-year rate, so this is the Australian rate, which is the one I used. It's probably quite well correlated with where I think rates are going to move to. Went up. It actually went well above 3, and then it's come back a little. So we're seeing a little bit of an up and then down, and I think we're going to see more of that. And in fact, the real interesting observation is we're seeing those same trends now in the US. So the US 10-year and 3-year also went very high and has come back a little. So the markets are beginning to think, well, there will be a rise. The question is, how quickly will it rise? How long will that rise stay? And how quickly will it fall? And the market's now trying to read beyond that. The question is, to what extent will central banks have to change their strategy, because it's all about trying to fix the inflation problem at the moment, to deal with the recession or the slowing economy, and the only way they can deal with that is to actually pull rates down. The nightmare scenario would be if, in fact, rates went up, inflation didn't come down, because then you're in stagflation territory, and stagflation is a horrible beast. It's very difficult to get out of. And then you get the second order effects, because then, of course, people want more wages, because then cost of living is going up, but their wages aren't. That puts more upward pressure on inflation. That means they've got to put interest rates up. That means you create more pressure, and so it goes on. That's the doom scenario that central banks are now trying to desperately get away from. But I think they've laid the conditions, unfortunately, because of 20 years of bad policy, for this to be a very tricky time.
I agree. You've got the ASX 200 here.
Yeah. Well, I just wanted to make the point that we're off not as much necessarily as some other markets, but we are off the tops. And it'll be very interesting to see. The markets have sort of taken a little bit of a more positive turn over the last 2 or 3 days. And in fact, in Australia, the markets have not come back as much as some other markets. But there are some very significant questions in terms of what the revenue flows will be from our major companies in terms of dividends. And of course, the costs of borrowing for many firms will also be rising because interest rates are rising. So to my mind, there's more downside than upside from here in terms of the local market.
Yeah, and the Aussie dollar's hovering around 70 cents.
Yeah, and the interesting thing too, of course, was we had a drop down and drop up, but got to understand the Aussie dollar is much more connected to what the US dollar is doing. So the US dollar got very, very strong. The DXY, the index, got up to about 105. It's now back to 102 or so. So there's been a bit more weakness now on the dollar. The reason is because the US dollar, that is because of this question about recession and when things are going to actually reverse. As a result of that, our dollar's been a little stronger, but it's not dramatically strong. Interestingly, with the Reserve Bank essentially going to start now quantitative tightening, that could have an impact on the dollar too. So interesting to watch how that plays out ahead.
Yeah, and probably been held up a little bit by the commodities and that sort of thing we've touched on as well.
Correct. But if you look at falling markets, the place to go is the NASDAQ, right? The NASDAQ's already in bear territory, and a lot of the big tech firms have had a real crunch in recent times. And it's now spread out to US retail. So there were some horrible results last week from some of the big retailers, which suggested that consumer momentum is also easing. And it's interesting that they talked specifically about supply chain disruption, the cost of goods rising, consumers less able to spend. And the other point to make here is that with retail numbers, of course, if people are spending more for the same things, the retail turnover should be going up, but doesn't necessarily mean that profitability improves. So it's important to watch that. But here we are. Tech is now in a very different place from where it was. And again, there's a lot of evidence to suggest that tech will continue to slide ahead. So again, more indications, I think, that markets are probably in very, very uncertain territory at the moment. And whilst people are talking about we've reached the bottom and it's time for a climb up now, more realistically, I think we're going to see further volatility, further ups and further downs, and probably more downside risk than upside opportunity from here.
Yeah, you've got the 3-year US rates as well, similar to Australia, peaking and coming off.
And just to highlight again, they went up, they've come back, and that's because people now are looking to beyond the heightening cycle from the Fed. And they're suggesting that maybe over the next 2 or 3 years, they're going to have to come back the other way. So again, it shows you how much on the knife edge we actually are.
And this is what we talk about when we say bond markets are the smarter money, and the Fed and central banks are behind the curve. A lot of bond markets have priced in these rate hikes or inflation and already starting to look to the future, as you say, about, well, once they hike them, is that going to throw the brakes on economies, and are they going to come back down? It's just interesting how far behind the Fed and other central banks are.
Yeah, exactly right. And I think the bond markets have been calling it righter than the Fed. Even a few months ago, right? Phil Lowe here in Australia, the RBA governor, said we won't be lifting rates until 2024 on the bond market. We're saying yes, you will.
Yeah, exactly.
So, same in the US, and I think they've probably got a better handle on the fundamental dynamics. And it's interesting that in recent times now we've seen those sort of peaks. The question is, are they really peaks, or are they going to actually come back and then go up again? Of course, there are a lot of speculators in the bond sector as well. But nevertheless, over time, I still have more confidence in what the bond markets are indicating than what central banks are saying.
You've thrown Bitcoin in here as well, Martin. It's been on a downtrend like a lot of the tech stocks.
Yeah, just to make the point that Bitcoin has been following, the rest of the markets, only more so. It's more than 45% off its peaks. But if you look at the longer term trends, of course, it's gone up, down, up, down, up, down, and there've been a number of relatively quick corrections, but then they've tended to move up again. But I also note that a lot of the altcoins have actually dropped further. And it looks to me, looking at the numbers, whilst the total market capitalization of all crypto has dropped dramatically, perhaps by nearly half, there's more of a swing back to Bitcoin as sort of the old stage is still there. And I still hold the view that the underlying philosophy of blockchain and what blockchain can do has not been busted by these financial moves. I know there are a lot of new investors who've lost a lot of money in Bitcoin. That may or may not be, turning around, but don't throw the baby out with the bathwater here, right? Whatever happens with regard to the markets, I think it's important to understand the fundamental philosophical point about the blockchain and decentralized and devolved and all of that sort of stuff. So there's a lot more here than just to saying, oh, look at the price, it's dropped, Bitcoin's falling apart. And interestingly, there's a polarization amongst those who are Bitcoin fanatics. There are some still very strongly believing that it's got a future. Others now switched across. So one to watch.
Yeah, I think we've seen a lot of the big tech stocks being battered, like a lot of altcoins have been battered. And I guess my underlying philosophy is that there's a lot, and the majority of the crypto coins that aren't going to work out or go to zero eventually or whatever, but the better quality projects and the blue chips, and certainly Bitcoin, and just go through these cycles, and over time, as long as monetary policy continues the way it is, I think we're going to see more and more countries come to see this as some sort of hard money or uncorrelated asset to add, as we've seen a lot of the African countries meeting about possibly using it as well. So I guess that's my belief, that it'll bounce back over time.
Yeah, well, we'll see. And El Salvador was one of the first, right? And that they actually, I think, bought quite a lot of a Bitcoin around 30,000 US, and of course they're sitting a bit below that at the moment. But it'll be interesting to see. So I'm with you. I don't write this off yet, but you need to understand much more about the dynamics of crypto land rather than just the headline news of it's crashed and everybody should get out. So that's not. And the other point to make, of course, is there's still conversations about more regulation of crypto, and there's a bigger conversation now about central bank digital currencies. And as we've discussed previously, one of the really interesting questions is the relationship between central bank digital currencies and how they're going to be rolled out and how that interfaces with the crypto world. Again, a lot of uncertainty there, but I'm expecting more news on the central bank digital currencies, and quite soon.
Yeah, I agree. 3-month RBA credit aggregate growth.
Yeah. So I just thought I'd come back and now talk about some of the specifics around housing and particularly Australian. So the latest RBA numbers showed that, in fact, the credit momentum is already easing. And, there was very strong growth in housing lending, owner-occupied and investor lending. Personal lending, not so much business, quite strong. But it looks as though it's easing back, and the intelligence I'm getting from those in the industry are suggesting that the forward momentum in terms of credit demand will actually continue to evaporate, not least because, of course, interest rates are rising, the banks are tightening their lending standards, a number of fixed rates have gone up. So, for example, Westpac yesterday announced considerably significant hikes in fixed rates as well as variable rates. Other banks are following as well. So we're seeing a much tighter market for credit. And one of the things that I've always been saying is that the rate of change of credit is the best indicator of what's going to happen to home prices. So not surprisingly, I'm now suggesting that home prices are going to slide. And in fact, we're seeing leading data from Sydney and Melbourne suggesting that prices are already easing a little bit. I think we're going to see more of that. So the chances of property prices in the short term rising higher, given the interest rate moves, is probably zero. The question is, what happens later? What happens when essentially the economy continues to go negative, and the Reserve Bank says, "Oh, hang on, we've got to deal with not getting a recession." We might see rates coming back. So maybe what we should expect to see is house prices dip a little bit, but maybe in a year, maybe sooner, maybe later, start to move up again as rates change direction. So we're in a very volatile, dynamic place at the moment.
Yeah. Financial stress as the trend continues higher?
So I just thought I'd highlight, this is from my own data, that the mortgage stress numbers are as high as they've ever been. The rental stress is as high as they've ever been. This is because of the issue with big mortgages for those who've actually got mortgages, higher interest rates, cost of living, fuels we touched on earlier on, food at the shops, pretty much wherever you look, things are actually pretty adverse. And I measure stress in terms of cash flow overall, not just proportion of portion of payments going on the mortgage. Rental stress very high. I'm very concerned about the rental sector. We've got a lot of people struggling in that sector at the moment. A lot of people who are facing rental increases, and therefore this is a very important leading indicator of difficulty. Not all of these are going to default, not all of these are going to fall over, but it just shows you the pressure on households. And whilst there are many people saying, well, households have got great buffers, if they've been saving like mad over the last couple of years, Frydenberg was saying that before he lost his seat, of course. The truth is that there are some like that, but there are also some that are actually really struggling. And I'm expecting stress to continue to rise because all of the indicators that we've been talking about suggest that more pressure on households ahead. Interesting to see what the government does in terms of any more support for households. I wouldn't be surprised to see something coming quite soon, a la what happened in the UK.
Yeah, one thing I just wanted to mention was we've already seen a lot of the people that own rental properties, and the banks telling them one way you can, I guess, secure yourself a little bit more is by increasing those rents and increasing your cash flow from your properties. And so that ends up being reflected in rental stress, the people that are paying more, but it's that pressure on people that think, can I afford higher rates? One of the ways to offset that is to charge more for rent.
Spot on. And the other one is that there are some investors who are now saying, well, maybe I should sell because basically I'm not sure I can make this work anymore. Yep. There are bigger numbers of properties on listings at the moment. In other words, people trying to sell them than normally at this time of year, dramatically higher. And a lot of high-rise apartments in particular are coming on the market because people are just not able to make the economics work. They can't actually put the rent up because there's not enough demand for that particular segment. And whilst overall rentals supply is very limited, it's not universally so. So, for example, some of the highest rental stress is actually in Victoria. Postcode 3000s, right in the middle of Victoria, right in the middle of Melbourne. And that's a really important point. So again, it's a matter of sort of looking across some different geographies, different dynamics. But a lot of pressures, and those pressures I think are not going away anytime soon.
You've got some mortgage calculations here for us.
Yeah, well, I just wanted to highlight what happens if rates go up. So if you have a mortgage rate of 1.99%, right, which is not out the road over the last couple of years, your typical principal and interest repayment over 30 years would be $365 a month, right? But if it went up to 3%, so that's a 1% improvement or increase, improvement from the bank's point of view and increase from your point of view, that's a 15.6% increase in the monthly repayments you'd have to make. So it may not sound much, 1%, but actually the impact on household budgets is huge. And if you actually go up another percent to 4%, that's a 31% increase in the monthly repayment, so $478 per month on average, and that's per 100,000 borrowed, right? So most people would have more than 100,000. The average mortgage in Australia is $400,000 to $500,000, much more in Sydney and Melbourne. So you can see here that there are huge upward pressures on households if rates do start to rise. And in fact, what I did was to run a bit of a sensitivity to say what would happen as rates rose, and we've got about 1.5 million households in stress in mortgage at the moment, mortgage stress at the moment. But for each 0.5% increase from here, you can get them another 150 to 200,000 households falling into stress. And in fact, if rates went up another 2%, that's almost another 300, 400,000 households who would have difficulty just managing their finances. So this is a really big deal.
And this is the interesting one I want to dive into about the opposite of the QE's quantitative tightening and how much open market operations the RBA did to try and keep rates low, and it didn't really work that well. But then they're going to have this problem as well if they're trying to sell and Australia's relying on overseas funding, that it can be further upwards pressure on our bond rates and interest rates.
Well, so it's very interesting. So the RBA has basically said we are going to actually do quantitative tightening, but we're not going to buy back. We're just going to let them run off. So there's a period of time. So not much happening this year, a little bit more next year, but in a couple of years, quite a lot. And by the way, there's another slide which I didn't include from the RBA, which shows the term funding facility for that really cheap money that they made to the banks is also going to have to be repaid too. So this is going to change the dynamics in terms of the bond market. And what it means is a lot of banks are going to probably have to pay quite a lot more for funding, not least because of the international as well as the local. The RBA is going to change its mode of operation, so it's not going to be throwing liquidity in, at least for now. But like I said, at some point, I wouldn't be surprised to see this swinging back, and I wouldn't be surprised to see later on the central bank starting to do quantitative easing again, starting to take interest rates lower, and maybe even getting into negative interest rates to try and stimulate the economy. Because, frankly, they've got this devil in the deep blue sea problem. They've got high inflation, and they've got significant pressures more broadly on the economy. This is really tricky now, and the question is, can central banks get it out of this? Probably not.
And another thing, they can force, pensions funds and investment funds and people to hold government bonds as well to try and offset the work that they have to do in the future, which is something we've seen in the past and may happen again.
Yeah, I've got this theory that the obvious thing is superannuation and superannuation savings. I wouldn't be surprised to see some initiatives coming out relating to that. I don't know what they'll be, but I could see, there's that big pool of funds. Well, why not make some use of those perhaps more directly? So we'll see.
All right. Next up here, housing tenure.
Yeah, I just wanted to share this before we close. The ABS released some data yesterday. Now, it's only up to 2020, but it tells the story significantly of less people have a home that they own outright than ever before. More people have a mortgage, and more people are in rental accommodation. So if you look at the last 20 years and you think that we should actually end up with more people owning their own properties outright, it's failed completely. We've got more people in rented accommodation, we've got more people with a mortgage, and in fact more people now holding mortgages into retirement, which means they've got to try and pay them off later. This is an indication that we've just had the settings wrong for at least the last 20 years across both sides of the government. Nobody wants to address this fundamental question. And as a result of that, with ever high housing prices and probably higher housing prices ahead at some point, I'm not sure it's going to get addressed, but it should be addressed because this is a real important leading indicator of trouble ahead.
Wages versus inflation. We know in Australia that we just haven't had those increases in real terms for a long time, and as usual, they're forecasting that things are going to get better and wages growth is going to outpace inflation in future. It's always promised that it's just ahead.
Promises. Of course, this is from the recent budget reports, and they basically show you that the inflation is going to be high but falling, and then wages will magically, overtake inflation ahead. Well, if you look past the last 20 years or so, they've been very bad at forecasting this and getting it right. I don't think there's much on the horizon in terms of prospect of real wages growth. And in fact, the next slide is a sort of an optimized view. This is basically from the Centre of Future Work. And what they've done is to look at the correlation between inflation and wages. And what they're basically saying is that if you're lucky, by 2024, maybe you might start to see your wages grow in real terms, but there's no chance of that happening anytime sooner. So if you put it all together, households are under significant pressure with inflation rising. The wages momentum is not there, and it's unlikely to be there for any time. We've got a lot of questions about whether central banks will have to reverse policy later in the year. Commodity prices are running through the roof. Cracks are appearing. We are in uncertain times. And I'm afraid that that's one reason why I think the markets will continue to grind lower rather than go higher, at least in the short term. And I guess we'll have to come back next month and see where we go from there.
Absolutely. Well, thoroughly enjoyed that, Martin. I hope you guys have enjoyed that as well at home. As you say, we'll do this every month and keep an eye on things. Any final thoughts for people at home? I'll put all the links to follow Martin and his work down in the description, like always.
Well, thanks for that. And yeah, I think the point there is you need to read below the headlines here, right? You need to understand some of these dynamics that we've touched on today. Unfortunately, the mainstream media don't really get into some of this detail, and therefore they tend to sort of portray a binary. It's going to be fine or it's going to be, terrible. The truth is there's lots of countervailing forces at the moment. That's why it's really important to get into the detail and understand some of this dynamic.
Couldn't agree more. Awesome. Thanks for your time, Martin. We'll do it again next month. Hope you guys have enjoyed that one. Cheers, Martin.
Cheers.
Thanks, guys.